Hi there. So welcome to another episode on the questions that we are solving on management accounting. To be specific, we are taking the topic on budgeting and looking at the various questions that we can solve on budgeting. In the last two series, we solved questions on purchases budget, and then in the previous video, we saw a question on the accounts receivable schedule and how we can get the cash receipt schedule, and the accounts receivable balance at the end of the period. In this question, we want to look at the another budget, which is the labor budget, and see how the labor budget is prepared. Remember, in case you missed the last two episodes, I'm going to link I'm going to put the link in the description if you are watching this on my YouTube channel, so you can check the description box for the last few videos. If you are watching this on the study portal also, you can go through your course outline and you already have that there. The questions also, you can check the description box if you are watching this on my YouTube channel and get access or click on it and download the questions that we are practicing and solving in this series. Remember also that you can subscribe to the channel, hit the notification bell, so that when we release new videos like this, you'll be the first person to be notified, so you prepare well for your examination. So let's get into it and let's look at how we can prepare the labor budget for this question. So let's see what we got here. Still on question 2C. Osiadan Limited, that's the name of the question. Osiadan Limited. So let me put that down above somewhere. Osiadan Limited. So Osiadan Limited is working on its direct labor budget for the next 2 months. Each unit of output requires 0.4 direct labor hours. The direct labor rate is 50 Ghana cedis, 8.50 Ghana cedis per direct labor hour. The production budget calls for producing 2,300 units in August and 2,200 units in September. So these are the 2 months we're dealing with, August and September. The company guarantees its direct labor workers a 40-hour paid work week. With the number of workers currently employed, that means that the company is committed to paying its direct labor force for at least 920 hours in total each month, even if there is not enough work to keep them busy. Required: prepare the direct labor budget for the next 2 months, August and September. So that is the labor budget we're going to be preparing for August and September. So let me put the heading up: labor budget, August and September. So how do we go about this question? This question is straightforward, just that there is a guaranteed minimum wage here given to the employees. So let's crunch the numbers and see what is happening. But remember, as always, when you're preparing your purchases budget, the purchases budget is going to be based on the unit that we want to produce. So the first thing we have to look out for is the labor hours required. So to get the labor hours required, that is going to be your units to be produced times the hour per unit. Okay? That will give you the labor hour required. But as always, when you're preparing the budget, the labor budget, you have to take into consideration ideal time as well as efficiency of labor. In this question, we don't see that there, so I'm not really going to be delving deeper into that. In another question, we will be discussing those things in detail. But if there is an ideal time, it means that we will require more labor hours than we need for the unit. Okay, because ideal time means the time that labor is paid, but they are not working. It could be because they are on break, they are on they've stopped working because of machine breakdown, or there is not resources available or materials available. So when we are factoring ideal time into the labor budget, it means that we will pay for more hours than we actually need for the units that we'll be producing. The reverse is true for efficiency of labor. So assuming we are dealing with labor efficiency, that is going to be different. Now, when we say labor is efficient, meaning they can work faster than required. For that reason, if we are taking into consideration labor efficiency, What it means then is that we will be requiring less hours than we need for the units that we want to produce because of the labor efficiency. But like I said, these two things are not in this question, so they are not going to be our really headache in relation to that. So let's crunch the numbers and go through and see how we go about this. So the first thing we do is, like I mentioned, the units by the labor hours. So let's go. August and September. You guys, August, September. Okay. So what do we bring first? The budgeted units. Budgeted production units, right? We are told that the company expects to produce 2,300 units in August, and I think 2,200 units in September. Good. So these are the units. Then let's go back to the question. The examiner said, each unit of output requires 0.4 direct labor hours. Okay. So hours required per unit. So required hours per unit. 0.41, 0.41. So let's see how it goes. 2,300 by 0.41. That's 943 here. I think that should be a bit less. 2,200. 902. So this is the labor hours required, okay? LHR, labor hours required. Now, once we have the labor hours required, we would have just multiplied the labor hours required by the rates per hour to get a cost of labor. But there is a statement in the question which is the guaranteed. So we need to take that into consideration before we determine which hour we will be paying. So this is the hour we need to produce the product we want to produce. But because of the contract the company, that is ACCA Limited, has with the employees, it means the labor hours to pay them will be different or may be different from the labor hours that they will actually be working. So let's go back to the question and let's role play. It says, the company guarantees its direct labor workers a 40-hour paid work week. With the number of workers currently employed, that means that the company is committed to paying its direct labor workforce for at least 920 hours per month. For at least 920 hours per month. What it means is that because of the guarantee we've given to the employees, whether there is work or there is no work, and that statement was given, in total each month, even if there is not enough work to keep them busy. So whether there is work or there is no work, at least we have to pay them for 920 hours. So what do? In order to determine the hours to be used to pay them, we will compare the guaranteed hours with the hours we require. If the guaranteed hours is more than the hours we require, then we will pay them using the guaranteed hours. If the guaranteed hours is less than the hours we require, then we will pay them using the hours we require. Did you get that? Let me take it again. Number one, we compare the guaranteed hours with the labor hours we require. Decision rule. If the guaranteed labor hours is more than the hours we require, we pay them using the guaranteed labor hours. However, if the guaranteed labor hours is less than the hours we require, then we pay them using the hours required. So if that is the rule, let's put that into our schedule and see how it goes. So guaranteed monthly hours. We compare, and that's going to be 920, 920. So labor hours to pay You are not adding, you are not subtracting, you are not dividing, you are just comparing. Be careful about that, you are just comparing. So if we check, we will need 943. We have guaranteed them 920. So which one is bigger? The 943 is bigger. So we will pay them using the 943. Now, in September, we need only 902 hours, but we've guaranteed them 920. So since the guarantee is more than the hours required, we pay them using the guarantee 920. Does it make sense? That is what I mentioned earlier in relation to the question. So now that we have the labor hours to pay, we were given the rate at 8 Ghana cedis 50 pesos. So rate per hour, and that is in Ghana cedis, 8.50. 8.50. So we sum it up, that gives us the labor cost. So let me grab my Casio here. 943 times 8.5. That gives us 8015.5 Ghana cedis. And then 920 by 8.5, still at 7820. So that is the answer to the question for this one in relation to that. Labor budget, sweet, simple, straight to the point. Remember what we did here? We compared the guaranteed monthly hours with the labor hours we required. The one that is bigger becomes the labor hours we will use to pay our employees. And that is what you must understand in relation to that. So that is it about that question there. Now there is a D aspect very briefly on that. It's a theory. Let me add it to this one. It's also important. It says, identify 3 assumptions of cost volume profit analysis. Identify 3 assumptions of cost volume profit analysis. Identify 3 assumptions of cost volume profit analysis. So 3 assumptions of cost volume analysis. You know it's the same as break-even analysis, right? The first thing we can talk about is that the total fixed cost remains constant while total variable cost varies proportionally with the output within a given period. So for the period under consideration, the fixed cost remains constant, but the variable cost changes with the output level. Second, total cost is divided into their fixed components and then their variable components, because when we are doing break-even analysis, we use the marginal costing principles. So we divide the fixed cost with the variable cost. Then another assumption is that the only factor influencing cost and revenue is production output or activity level. The only factor influencing cost and revenue is production output or activity level. You know, there are other factors that could affect the cost of a product, that could affect the revenue of a product, but under break-even analysis, we assume that the only factor that influences these 2 components or these 2 things is the output level or the units that a company is producing for the period in consideration. Then another assumption is selling price is constant throughout the period of the discussion. So the selling price remains the same irrespective of the output level. Then there are no changes in stock levels, or where there are, they are valued at marginal cost only. What it means is that we assume that there are no opening stock or there are no closing stock, so all units produced are actually sold out. But even if we produce something and it is not, all is not sold, under the break-even concept, we will value it using the marginal cost, meaning we will just look at the variable cost of making the product and not take into consideration the fixed cost in relation to that. So these are some assumptions that you have to understand under break-even analysis. In another video, we'll be solving some questions under break-even analysis, where you look at how the analysis is done, how you can do various computation and various calculation for a company. So that is what you must understand in this series. The question 2 gave us the purchases budget, it gave us the how do we call it? The purchases budget, give us the receivable schedules, and then also the labor budget. So thank you for watching. I'll see you in another video as we continue with our discussion. As always, remember to comment below with any questions that you have on this video or any other topic that you want us to cover in this series. Then also remember to subscribe to the channel and hit the subscription button, because every single day we are releasing new content to help you to prepare well for your examination. Above all, make sure that you give us a like and make sure that you share the video with your colleagues, so that together we can assist many students across the country, many students across the continent, and many students across the globe. I'll see you in another video as we